Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Gold has had a spectacular run lately. Last week, fears of a trade war saw the price of the precious metal jump by more than $100 an ounce to a new record of just under $2,900 an ounce. That's a spot price. Futures were even higher. With uncertainty still a dominant theme in global markets, it's continued to rise. How far can it go, though? Could gold pass the $3,000 an ounce mark? And what does it mean for investors? Remember, this is general information only, and you should seek professional advice before making investment decisions. Chris Brycki is the founder and CEO of online investment advisor Stockspot. Chris, welcome back to Fear and Greed.
Thanks, Sean. Always good to be on.
Are you surprised that we're talking about $3,000 an ounce for gold?
Look, I think yes and no. I think this year it's really thrown a few people the big move in gold or over the last 12 months, mainly because the conditions that we've had, which is rising long-term interest rates and a strong US dollar, usually aren't conducive to a strong gold price. They're usually actually big headwinds. And so gold has really defied a lot of these, market conditions that would usually hold it back and surged forward. It's not so much of a surprise to me because I think there's really other factors that are driving it. And some of those traditional factors are really just playing less of a role.
Okay, so what are some of those factors? I'm guessing there's one big one.
Well, people talk about global uncertainty, and I think you can talk about, the wars that have happened and what's happening in Russia and Ukraine and Israel. But I think these are all sort of side stories, and the biggest challenges we face from an economic standpoint globally is China's deflationary problem. But bigger than that is the US's persistent inflation issues. And I think the fact that the US government debt has increased so significantly from about 23 trillion around the COVID crisis time to 36 trillion today, I think that's kind of laying the foundations for a bigger debt crisis. And that's really what's driving gold.
And so the whole thing about gold, is it the store of value argument? Is that why investors in times of uncertainty go for gold?
It's really a replacement for money. So the challenge with money is that governments really can dictate the supply. And if there is a debt problem, then governments can print money to service their debt. They can allow inflation to stay higher for a longer period of time and basically inflate their way out of debt. Gold is a way of protecting the real value of your money in that sort of condition.
I mean, the point there, I suppose, that, someone told me all the gold ever mined wouldn't fit under the Eiffel Tower. There's actually not that much of the stuff around.
That's right. I think someone's showed me the visual and it would all fit into essentially a tennis court. If you can imagine a tennis court cube, all the gold basically fits in there. Look, there's not a lot around. And although it does seem to many people like a bit of an archaic thing to, as Buffett, I think, discussed, like dig it out of the ground just so you can bury it again in a vault. It really is a store of value that people have relied on for a long period. But it does go through decades of not really performing and then decades of doing very well. And I think we've entered, one of those strong performing decades, most likely.
And when central banks around the world are buying up gold, that can't hurt its reputation either.
That's right. I mean, that is the other factor that has been cited over the last year, that central banks, particularly, in the East, the Chinese central bank have really been big buyers of gold. And this, has been an accelerating trend that we hadn't really seen 10 and 20 years ago. But I think a lot of these crises that are happening from a war perspective globally are leading central banks to really repatriate money and also to bring gold back home as well.
So what's the big downside to gold? So this is all why gold is rising. Could it turn on a dime?
Look, the big downside to gold, and the reason why some people have a zero allocation, Vanguard famously doesn't have any allocation in their diversified funds, is because they don't see it generating a yield or any sort of return. You only get your return through capital gains. And so in theory, in a period of high interest rates, you're missing out on an interest rate in gold, and it needs to go up every year by as much as interest rates to compensate you for not getting that interest. That's certainly the reason I hear bandied around a lot, that it just doesn't produce a yield. Why would you own that asset? My counter argument is there was a period, a few years ago when a lot of government bonds weren't generating any yield and many of them generating a negative yield, and yet still people invested in those as a defensive asset. So I don't think you can look at yield alone. You need to think of a total return.
I still want to talk about investing in gold, including some of the ways people are doing it. We'll be back in a moment. My guest today is Chris Brycki from Stockspot. Okay, so we've gone through the fundamentals of gold, let's say. How do you invest in it? If I want to invest in gold, how do I do it?
Well, of course, historically, the way that people would invest in gold is literally to buy physical gold. So whether it was through jewelry or buy gold bullion or bars, you can buy it at a gold bullion dealer, and then you can store it either at home, in your own vault under your mattress, or you can go and pay a vault to store your gold for you. That can make sense for some people. You certainly feel pretty secure when you've got your gold in the vault, but it can be expensive to kind of hold it in that way. And so about 20 years ago, an Australian actually invented the first gold ETF. And a gold ETF is similar in some respects. It still stores that gold physically in a vault. For instance, the gold ETF we recommend at Stockspot stores the gold in London in a vault.
Right.
And that vault is insured by the Lloyd's of London. So your money is safe and in a vault, but you don't have to store it yourself. And so the costs are much lower.
So an ETF is kind of the most common way nowadays?
It's certainly the most efficient. I think the gold ETF in Australia, that's been the most popular one, just crossed over $4 billion assets under management last week. And so there is a lot of money sitting in that. I think some people still like to hold jewelry and physical bullion and bars as well. But these days, if you're going to own gold as part of an investment portfolio, I don't see a lot of downsides of holding it in that ETF structure.
So, you've mentioned Vanguard before the break, and in a sense, what we're talking about with ETFs can be institutional or retail. If we just think institutional, do they mostly invest via ETFs, or are they big enough to do it themselves, or it's kind of not something I've thought much about?
Usually via some sort of either by a future sort of product. So you can buy financial contracts that give you exposure to gold, or via an ETF. Although, from my research of super funds in Australia, most super funds have a zero or negligible allocation, which I think is interesting. I found one or two funds with like a 1 or 2% allocation. We've put out our super product recently with a 15% allocation. It's a much bigger allocation. And I think a lot of super funds will really get squeezed into buying gold over the next 10 years if government bonds continue to perform, poorly compared to gold.
Okay. So, where is you've just taken me down a little rabbit warren here. Where is most of the gold held? I remember as a graduate and going and working at the Reserve Bank and looking at the vault at the Reserve Bank. There's literally gold bullion bars in Martin Place in Sydney down the bottom there. Now they don't have them anymore. Where is the gold?
I mean, personal gold, I think you're right, is still often stored in vaults in banks. And, when people have concerns about the viability of banks, you'll often see a run on those storage vaults because they're worried. And that happened in Europe in the, Greek debt crisis a little while ago. So that's one place. Central banks have their own storage facilities for gold. And actually, one of the interesting things that's happened over the last couple of weeks with Trump proposing tariffs on Mexico and Canada, historically, when there's been tariffs, gold and similar products have been exempt. But, there wasn't an exemption for gold in these recent tariffs, only energy. And so there's been a lot of moving of gold around the world from one vault to another to try and avoid tariffs, because in theory, tariffs are now going to be imposed on gold bullion being moved from Canada to the US.
Oh, wow. So where is most of the gold mined? I mean, Australia's big into gold and South Africa's big into gold. Are they the main places?
Yeah, there's a few countries that are big miners of gold. Australia, Canada, South Africa, as you mentioned. China does produce a lot of gold. So gold is produced in many countries. Some have imposed limitations on exportation. So, for instance, China, from my understanding, doesn't allow any gold to be exported. They keep it all, whereas Australia is an exporter of gold.
Okay, so the moral of this tale, we know why gold has done what it's done. It still can be part of a investment portfolio, and you mentioned your own super fund at 15%. So you're obviously a fan of holding it as a defensive asset. Is that right?
Yeah, that's right. I think people are sometimes confused about where gold fits, but really it's the most pure form of money. So in my mind, it's definitely a defensive asset. The other thing that makes it defensive is it has a wonderful negative correlation to Australian shares, which means that historically when Australian shares have fallen, gold has done very well. And what's, I guess, another layer interesting on this is when Australian shares and bonds both fall together, which is very rare, it's usually due to an inflation scare, and that's when gold really shines. And so I think, that's the potential outcome over the next 10 years that I think a lot of people aren't thinking about, that if there's inflation that's persistent, you may see shares and bonds both having a pretty poor period, and that's where gold is likely to, do a lot better.
Chris, thanks for talking to Fear and Greed.
My pleasure, Sean.
That's Chris Brycki, founder and CEO of online investment advisor Stockspot. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.